What if I told you that one of America's sweetest success stories almost collapsed overnight? Krispy Kreme, a company that grew from a small donut shop into a billion-dollar empire, lost nearly 80% of its value within just a few years. So, what really happened to Krispy Kreme? How did a brand that once symbolized sugary happiness become a textbook example of how rapid growth can destroy a business? To understand the decline, we must first discuss the rise. Krispy Kreme was founded in 1937 in Winston-Salem, North Carolina, by Vernon Rudolph. He started with a simple idea: sell hot, fresh donuts that people couldn't resist. And it worked. Customers would line up outside the shop, drawn in by the irresistible smell of freshly glazed donuts. For decades, Krispy Kreme grew slowly but steadily. The company didn't rely on flashy marketing or rapid expansion. It focused on building a community. The brand became ingrained in American culture, becoming the go-to choice for fundraisers, school events, and office treats. The Good Times Donut. However, everything changed in the late 1990s. The boom and the beginning of trouble. By the year 2000, Krispy Kreme had become a national sensation. When a new store opened, lines would stretch for blocks. Customers weren't just buying donuts. They were enjoying the experience of watching the iconic Hot Now sign light up and seeing donuts roll off the conveyor belt in real time. The company went public in 2000. The stock price tripled within a year, and analysts began calling Krispy Kreme the next Starbucks. However, this comparison was dangerous, as it led to the same mistake that has derailed many companies: overexpansion. The expansion trap. Krispy Kreme's management became obsessed with growth. Instead of focusing on product quality and sustainable profits, they concentrated on how quickly they could open new stores. By 2003, they were launching new locations at an almost reckless pace, often within just a few miles of each other. Their logic was simple: if people love our donuts, we just need more stores. But business doesn't work that way. Demand doesn't automatically increase with supply. Soon, franchisees began competing with one another, sales per store plummeted, and profitability disappeared. Here's the critical mistake: Krispy Kreme expanded outward before reinforcing its foundation. Rather than becoming a strong, steady national brand, it transformed into a fragile empire built on hype. The franchise problem. This is where things get technical, but we'll keep it simple. Krispy Kreme's business model relied heavily on franchise revenue. This means they didn't just make money from selling donuts, they also profited from selling franchises and equipment to new franchisees. Initially, this looked fantastic on paper. Every time a new franchise opened, Krispy Kreme earned instant cash from franchise fees and equipment sales. However, this created a dangerous illusion: the company's profits were coming from expansion itself, not from actual customers buying donuts. It's akin to getting rich by selling the dream of getting rich, rather than through real customer sales. When the expansion slowed down, this illusion began to unravel. By 2004, Krispy Kreme was riding a sugar high, and it was about to crash. The health wave and brand shift. Timing was another adversary. In the early 2000s, the United States began shifting toward healthier lifestyles, with low-carb diets such as Atkins and South Beach gaining popularity. As people started cutting sugar and carbs, Krispy Kreme's main products, sugar and carbs, faced a decline. Simultaneously, competitors like Starbucks and Dunkin', along with newer coffee chains, rapidly adapted by adding low-calorie drinks, sandwiches, and healthier menu options. Meanwhile, Krispy Kreme doubled down on donuts. The result? A brand that suddenly seemed outdated in a fast-evolving market. They were slow to diversify, slow to adapt, and quick to overpromise. Wall Street noticed. The accounting scandal. By 2005, Krispy Kreme's image took an even darker turn. The company faced an investigation into its accounting practices. Allegations surfaced that Krispy Kreme was manipulating its numbers, inflating profits, and employing aggressive accounting tactics to present growth in a more favorable light than it actually was. Whether this was intentional or a result of mismanagement, the damage was done. Investors lost confidence, franchisees began closing stores, and the company's stock price plummeted by almost 80%. The transformation from media darling to financial disaster happened almost overnight. The aftermath: shrink to survive. By the late 2000s, Krispy Kreme's empire had crumbled. Hundreds of stores closed, franchisees went bankrupt, and the brand's reputation suffered a significant blow. Yet here's the interesting part: Krispy Kreme didn't die, it just shrank. The company refocused on its core strengths: fresh, high-quality donuts and strategic locations, rather than oversaturating the market. They realized something powerful: it's better to have fewer profitable stores than hundreds of unprofitable ones. This slow rebuilding process took years and taught the company painful but valuable lessons about sustainable growth. The rebound and the second life. By the mid-2010s, Krispy Kreme was quietly making a comeback. They simplified their menu, improved store designs, and leaned into nostalgia, reminding people of what made them love the brand in the first place. Then came a turning point. In 2016, Krispy Kreme was acquired by J&B Holding Company for about $1.35 billion. Under new leadership, Krispy Kreme shifted its strategy from aggressive expansion to a more focused, experience-driven growth approach. They invested in online ordering, delivery, and partnerships with grocery chains. During the 2020s, something interesting occurred. Krispy Kreme became relevant again. They began creating viral campaigns, limited edition flavors, and pop culture collaborations that spread like wildfire on social media. They transformed the Hot Now experience into a digital phenomenon, making it appealing again for a new generation. So yes, the donut empire nearly collapsed, but it didn't stay down. Krispy Kreme's story isn't just about donuts. It's about business strategy, ego, and timing. Here are the 3 biggest lessons every entrepreneur or investor can learn from this story. Growth is not the same as success. Rapid expansion can be exciting, but if it's not backed by demand, discipline, and solid infrastructure, it becomes a ticking time bomb. Krispy Kreme's decline illustrates that fast growth without balance can lead to collapse. In business, sustainability outweighs speed. Don't lose sight of your core product. When Krispy Kreme chased franchises and quick profits, it lost focus on what made people fall in love with the brand, the product. Consistency, freshness, and customer experience are crucial. The moment a brand forgets what made it special, it becomes replaceable, and replaceable brands fade quickly. Adapt or get left behind. Markets change, and consumer preferences evolve. What worked 5 years ago might not work today. The healthiest companies don't fear change, they anticipate it. Krispy Kreme took too long to adapt to health trends and technological shifts, and they paid the price. However, they eventually learned that survival belongs to the flexible. At its peak, Krispy Kreme symbolized indulgence and joy. But when joy turned into greed and growth replaced quality, the sweetness turned sour. Yet, their comeback proves something hopeful. Even when a brand loses its way, it can rebuild if it's willing to learn, simplify, and reconnect with its roots. Krispy Kreme's story is about the universal truth of business. If you grow too fast, forget who you are, and ignore the customer, success can vanish as quickly as it appears. So what do you think? Was Krispy Kreme's downfall inevitable, or could it have been avoided with better leadership and management? Drop your thoughts in the comments. I'd love to hear your perspective. If you enjoy in-depth explorations of business stories like this, the real rise and fall behind famous brands, be sure to hit the subscribe button and turn on the bell. Next, we'll uncover another story that will change the way you think about business forever. Sometimes success isn't destroyed by competition, it's destroyed by the company itself. Krispy Kreme's story serves as a reminder that in business, growth can be sweet, but too much sugar can make you sick.